morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Wednesday, August 10th, 2022. And our top story today, ESG investing isn't designed to save the planet. Well, joining me now to discuss this and a lot more, Kenneth Pucker is a senior lecturer at the Tufts Fletcher School, and Andrew King is a professor at the Questrom School of Business at Boston University. Ken, Andy, thanks so much for joining us on the program this morning.
Thanks for having us.
You gentlemen wrote a really interesting piece in the Harvard Business Review about ESG, and ESG is something that we talk about on this network quite a bit. And Ken, I want to come to you first to kind of kick off the conversation. ESG isn't just about saving the planet. That's the title of your article. It's not about saving the planet. It's a lot more than that.
Actually, I think we contend that it's a lot less than that. It would be nice were people to be able to invest their money behind their values and get both planetary impact and financial benefit. And it's a narrative that has been sold by many in the asset management industry for the last about 10 years. But it turns out that it's hard to do. And while there are instances where one can get that win-win, it's a lot less frequently than we would hope.
And Andy, I want to pick up on that because, this is, as I introed this segment, I mean, this is something that has really just picked up. And if you're not down with ESG, maybe you're not down with saving the planet, but to Ken's point, it's really hard to align each of our individual values when we're investing our monies.
Right, but following on what Ken said, the value that is being advanced in most ESG is such a big thing that it's really hard to put your hands around it, is advancing your own return. So if you look at something like the Principles for Responsible Investing, which say that they're going to be principled by investing in ESG, the point of that is to increase returns. They're not saying it's going to improve impact. They're saying it's going to increase returns. So if you're putting money in ESG, the main thing you're hoping to get, and the main thing I think you are even being promised that you can get is returns. Whether you get them or not, that's another question.
Yeah. Now, can I ask you as a follow-up to that, Andy? When you look at the data, you go to like a Morningstar or one of these other entities that tracks this. Are investors getting the return? Are they getting the bang for their buck, at least initially? And I want to get into the who, how, why in a minute, but are they getting the bang for their buck?
Well, it depends on who you listen to. So certainly if you look at some of the back-tested investments that are made and advocated particularly by sell-side people in those kinds of companies, you'll see some returns. You'll see those graphs expanding and look, they did better. On the academic front, the evidence is much sparser. And in some cases, I think it's been overstated. In fact, some of the work that I've been doing has been to rein in some of the claims by the academics. So I don't think we really see it confidently on the academic side yet.
And Ken, let me come over to you because I want to follow up the question I asked Andy and give it to you. But also, as a layperson, there's a lot of things that get branded a certain way, but it can be very confusing. I mean, there's 50 different flavors when you go to the local Baskin Robbins or whatever your favorite ice cream venue is, right? Ben & Jerry's, whatever. And it's confusing. It's hard to make a choice. So doesn't this confuse investors?
I think that's a great point. In the US right now, there's very little regulation over how an asset manager can brand a fund. And so you'll see that many funds have been labeled ESG are just funds that were rebranded from traditional vanilla funds. So a good example is Vanguard has a fund. Its largest ESG fund and longest standing is almost one-to-one correlated with the S&P 500. It's just branded as an ESG fund. What you can be reasonably certain of, though, as an investor, is that you'll pay higher fees for funds that are branded ESG. And so typically on average, ESG funds charge about 40% more than traditional funds, which I think also gives us pause and makes me think at least that over time, the returns will be less from ESG funds.
Just to follow up on that, I mean, it's if I'm going to pay 40% more for ESG, what's the argument for paying more if I'm going to get the same return or similar return to an S&P 500 fund? I mean, if I'm just buying something that's just been rebranded, reshelved, and we're picking a little bit on Vanguard, but there are others as well, what's the value for the investor?
There could be two sources of value. One is, like Andy was saying, ESG funds are based on, are supposed to be based on the fund contents being better managers of risks associated principally with climate, but other changes in the planetary system. And so if in fact they are better managers of those risks, over time, those companies should perform better and you should generate higher returns. That's what's being sold. So one thing that's being sold is returns. The second is whether you are able to also advance planetary welfare. So maybe you want to pay more for a fund if you think that it's going to help contain climate change or help reduce income inequality. It's our contention that in probably over 90% of the incidences, planetary impact isn't even measured. And fund managers aren't compensated on the basis of being able to deliver impact as a result. So it's very unlikely that the vast majority of ESG funds are having a planetary impact that's positive.
Yeah, Andy, I want to come back to you, and then I need to go to a commercial break, gentlemen. But just to kind of build on what Ken was saying, you know, if there's regulators out there watching the program, one, it sounds like, and I'm not going to put words in your mouth or Ken's mouth, but it sounds like we need more regulation potentially around how these products are being defined for the best interest of the customer. I mean, most people, again, they're like me, they're lay people. They may not be experts in investments. They may not be an expert in ESG. They just know that they have this piece of money that they want to invest, presumably for the long term, and that they want to do good with it.
Yeah, I mean, I think there are two big things. One is it's important to remember that, and this needs to be regulated, or at least the marketing of it does, that ESG, most ESG now, is not the effect of the firm on the planet. It's the effect on changes in the planet on the firm. So it's not like your money is going towards good. It's that it's just trying to figure out what risks you'll face as regulation changes and climate changes and stuff like that. So that's single materiality. And we need to understand that we also want to know how the firm affects the planet, both directions, number one. Number two is the measures are all over the place. There's some really excellent research to show that the different measurement companies don't often correlate very well on how they're measuring that first part, the single materiality. And we need standardization of that.
Well, gentlemen, as I said, I need to take a very quick break. When we come back, we'll talk more about ESG investing, and we'll break it all down for you. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repair for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. We're talking this morning to Ken Pucker of Tufts Fletcher School and Andy King of the Questron School of Business at Boston University. Ken, Andy, thanks so much for staying with us this morning.
Sure.
No problem.
We certainly appreciate you lending a little bit of your time, and I feel like I'm back in class again, which I think is a good thing. I always like learning. I like to be a lifetime learner and a lifetime practitioner. Andy, I want to pick up the conversation because as you and Ken were talking about this, I'm a veteran of the U.S. retirement industry, over 30 years in the space, and what I seemed to hear from you was very similar in that active versus passive debate, and that is, what's the manager doing to generate additional alpha or value to the customer to realize the additional fee that they're charging versus a passive manager? Am I right about that?
Yeah, I mean, I think that's the direction of my thinking too. So in the 90s, I was involved in some of the early companies that were interested in trying to measure ESG. And the point of that was to give exactly what you're saying, managers more information so that they could better pick what they thought were well-managed companies that would have higher return. And so that's, I think, the underlying logic. What's happened over time, I think, is you've gotten almost flavors of greenness. Ken and I talk about light green firms, which are branded ESG. They probably aren't active. It's almost labeling. Maybe there's a little screening. And then you got deep green ones that are doing much more intensive research and analysis. And I think that's one of the problems is that you've got to be really clear on what you're getting.
Yeah, and Ken, I want to get you to follow up on what Andy said, but it does sound to me like this is not a mature market, or maybe it's my lay perception. This is something that is beginning and growing, so that we need more disclosure from firms. But how do you see it? Is this similar to active versus passive? And are we going to get, with maturation, more disclosure?
Well, active versus passive is really relevant in this context because you're right to note that there was a big shift in the asset management industry from funds that were actively managed to ones with lower fees that were passively managed. ESG investing from the asset manager side of things is a way to have fees go back up, because if they're charging 40% more, it fights against the trend you described, which was from active to passive. So I think it's a really relevant point. Your point about maturity is also true. Estimates are that the ESG investing movement is now sized at around $35 trillion, or 1/3 of all professionally managed assets. But that's a big tent measurement based on self-declaration of what is constituted as ESG. It's more likely that a sober assessment would be that the industry is about 1/10 the size right now. And so it is immature. And I do think we will end up with regulations, certainly of branding and what can be included in the ESG fund going forward.
So Andy, in the meantime, there are many fiduciaries out there who have oversight of pension plans, 401k type plans, there are 403bs, 457s, maybe even other asset pools. I mean, how do you scrutinize what is an evolving marketplace to ensure that you are delivering benefit for your beneficiaries, right? I mean, that's the role of a fiduciary. Your job is to make sure that you are acting in the best interest of these beneficiaries.
I think I'm above my pay grade here, but because that's a big job, but let me just say this. I think fiduciaries should think about, in the early days when I was helping develop some of these measures, we didn't even call it ESG. ESG wasn't invented until 2004, I think. It was just other information about the firm that might be helpful for letting you, decide what their future returns would be. And I think you should think about it that way. Think about it, avoid the hype, avoid all the advertising, and you just think, what can I do with these data that will allow me to be more responsible to my investors?
And Ken, kind of same question to you, but also it sounds to me, and again, there's a lot with getting people to save for retirement. In my mind, and I want to get your thoughts about this, is it more about communicating? So people who are responsible, they're fiduciaries for assets, these types of plans. If they're going to add a fund, for example, you got to be able to communicate in some way your rationale as to why you and the committee selected the fund and what, how does that adhere to the value and benefits to the beneficiary?
Well, two things. One is the SEC is currently looking at a new branding and naming regulation for ESG funds going forward. So I think they're aware that the hype has gotten a bit out of control. The second thing is, I didn't mean earlier to pick on Vanguard, because you're right to note that most asset managers now have ESG products, including BlackRock and State Street and all the other large asset management firms. But were I to try to give someone advice about how to maximize returns, I would actually advocate for Vanguard's methodology, which emphasizes low fees.
Yeah, really important. At the end of the day, and we're talking about the person on the street, right? They're investing. They could be a retail investor. They could be a retirement investor. They're investing traditionally for the long term. They're not arbitraging. They're not doing day trading, right, gentlemen? So it's about trying to maximize the value. Last question before we end the segment, gentlemen. And maybe I'll start with you, Andy. And where do you see this all kind of? You've obviously been working with ESG type funds for a while. You've seen this thing kind of develop. What does this marketplace look like maybe a year from now, or even, I'm going to get you to look at that crystal ball, maybe 5 years out from now?
Well, correction, I've mostly been on the measurement side, but
sure.
And I think that's a big issue. Again, I think there is thirst for impact. So not just return, but there's thirst for impact. And I think knowing how we're going to measure impact and whether we can even do it well is the area that I think there's going to be changing the most rapidly in the next couple of years. And so I think you'll see overclaiming on impact, you'll see doubt about impact, you'll see refinement on measurement. But I think a lot of it's going to be about funds now moving towards claiming impact. That would be my guess.
Ken, just as a follow-up to this piece, you and Andy have done a lot of research. What's the future look like? I mean, are you and Andy going to continue to follow this marketplace? Is it of a particular interest to you both? And what's the next in terms of your analysis?
Well, I think what's of interest to us in general is to try to help bridge the chasm between rhetoric and reality. And what I hope happens is I hope that the good tools that have been invented to help investors understand the future prospects of companies, looking at ESG type measures, I hope they get incorporated into traditional fundamental investing. And that fundamental investing doesn't have a separate moniker called ESG, but that there are funds that are truly impact funds, like Andy said, that do have requirements for measurement of impact. And so it would be great, I think, 5 years hence, if we had a traditional fundamental investing market that incorporated ESG tools, if ESG as a moniker went away, and we had a separate growing area of impact funds.
Well, let's hope the regulators are listening, whoever is developing these brand specs or these disclosures. Gentlemen, we're going to have to see what becomes of all this, but we look forward to having you both back on the program again very soon. Thanks so much for joining us this morning.
Thank you.
Thanks for having us.
That wraps up this episode of BRN AM. Have a topic of interest, somebody you think we should talk to, drop us a line. And don't forget, for all the latest curated news in lifestyle, wellness, finance, tech, so much more all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to search our archives, check out our latest content, we'll visit our website, and of course, our streaming partners. We're back again tomorrow for another edition of BRN AM. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes. Now is your opportunity to co-create content around any topic on the first lifestyle and wellness network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.